Alison Creamer here with Conversations with Creamer, and we have our sponsor guest. If you haven't noticed on the blog, we have actually started letting you guys know that James Walrod with Veterans United is a premier sponsor. So when you do call and help get your loan through him or even ask questions, it lets him know that the podcast is reaching out. So today we're going to talk about your taxes, self-employment, rental income, deductions, and how all of that can affect your mortgage and your buying power. So, James, go ahead and do your legal disclosures.
Absolutely. Good morning. If there's any compliance police out there, this is James Walrod with Veterans United Home Loans. My NMLS number is 260324. Glad to be here with you, Allison.
Yes. So we've recently had a few buyers making loan application, and it seems like the mompreneurs, the self-employment type of community is really rising more and more. I think people are looking for how to be in charge of their own income. So let's talk about what happens when you're self-employed or you have a side business. And while we're not tax advisors, we're not giving you tax advice, we are talking about real life applications that happen when you write too much off and then you want to prove that you can afford a particular house payment.
That's right. So what we need to understand kind of at the base of this is that for the most part, mortgages is a government process. These loans are backed by the government in a lot of ways. And so therefore, if they're going to give somewhat of a guarantee or somewhat of a backing on a particular loan, they also want to make sure that whatever income we're using to qualify them, that they got their fair share in taxes on. So when it comes time to buy a house, one thing that we have to look at is your tax returns and what is it income that you claimed and how can the income that you claimed be affected by things that you may or may not write off. A big one that we see is folks that are self-employed. So if you don't work for somebody else, you work for yourself, you've got a thriving business, just be careful what deductions that you are taking. Make sure that you are trying to give the most realistic picture of the money that you make. We completely understand that it's great to pay not a whole lot in taxes, but just understand that if you're not paying a whole lot in taxes, it's possible that you're not claiming all of the income that you make, and when it comes time to buy that house, that could have a negative impact.
Yeah. So a couple examples that we've come across. One, somebody who is all commission-based. And such is my line of work. I am commission-based. I don't have an employee status. I can write off probably quite a bit in my line of work, which is great because at the end of the year, it says maybe I made, $80,000, but I wrote off $40,000. And so I'm only going to be able to purchase a house based on $40,000 worth of income because I wrote off so much.
That's right. The key thing there is that we're going to have to look at your past 2-year history on your tax returns. So if when you're talking to your loan officer and they say, hey, how much money did you make over the last 2 years? And the answer is, well, I made $80,000. Just make sure that you're taking a peek at those taxes or submitting them to that loan officer so they can take a look. Because if you did, in fact, write off $40,000, in many cases, we can only use that $40,000 for qualifying income.
Yeah. All right, so you have a traditional job. You are an employee, you're a school teacher, and you make $45,000 a year. But on the side, you do Beachbody, you do Prove It, you do doTERRA, you do Young Lit, you do something because, you want to have some fun, and your tax person has said, oh, well, you can write this off and this off and that off because you're a business. Now what happens?
Absolutely. This is a huge trend that we're seeing, that almost everybody has a side business. I think the fun term for it is a side hustle.
Yeah.
So everybody's got something going on that's not their 9 to 5, which is great. It's a great way to make part-time income. It's a great way to supplement the income that you do make. But just be careful how you handle that on your taxes. If you state that you lost $10,000, in whatever it is that your side business is, in most cases, that's going to have to be taken into consideration. I have seen that if you have closed a particular business and you don't do that anymore, if you can prove that it was closed, and that can be difficult sometimes if it wasn't something that you actually had filed with the city or the SEC, but if you can prove that you actually have closed the business, we don't have to count those against you anymore. But if it's something that you're still operating, especially if it's early on in the business. So let's say in 2016, you just started it, you bought all your inventory, and you had a huge loss. Well, now in 2017, you're doing awesome and you're making money. We have to go by the history, the last tax year's history. So just be careful how you're handling that, and definitely talk to your accountant about what you want to write off and what income you did make, especially if you're thinking about buying a house in the future.
I mean, the tax laws are there, and this is why sometimes people feel like the rich keep getting richer, but there are rules that you can use that can hurt you or help you. And a smart person, or should I say an educated person, will ask the right questions. You can't worry about just today if your goal is to be a homeowner in a year or two. So if you have somebody filing your taxes, you kind of have to talk to them about that planning part of it. And I think that's where a lot of people fail, and they don't realize it until they're up against that brick wall. They didn't ask, hey, I'm looking to buy a house in the next 2 years. You know, that tax advisor could probably help advise you on how to show your income to be where it needs to be for the house that you want, especially maybe you don't write off as much. And yes, that means you'll pay more taxes. But in 2 years, you're going to show the income to qualify for the home that you really want. And then you can go back to writing things off if it's a legitimate tax write-off.
You know, one question or one answer that I get to a question that I ask a lot, which is if I ask questions about your tax returns and how you claimed things, if I don't have them in front of me, a lot of people say, oh, my tax guy handles that for me.
Yeah.
I don't deal with that. And so my advice is get to know your accountant. When it comes tax time, even if it's once a year, it's a great exercise to sit down and say, will you go through this 20-page document with me and tell me why?
I love the analogy. Do you say, oh, my dentist takes care of my teeth? No, you still have an everyday participation to maintain something. So even my understanding is even if you get audited, the whole, oh, my accountant does it is not always going to work.
Sure.
So you do have to be aware, especially if you're in that 2-year mark, you're thinking about buying a house or upgrading, you really need to look at what are you claiming as income. So recently, we've had another issue, rental income. Maybe you have a PCS move. Maybe you have a home in another state. You've moved here. You have a rental income. You have to make sure that you're filing that properly. We've recently come up against a rental income discrepancy.
Yeah, absolutely. Rental properties are, when you have a rental property in the mortgage world, it is very important for us to see the history on tax returns for that in most cases. Now, if you're doing a VA loan, you can convert a primary residence into a rental, and it's very easy. We don't need to see tax returns for that. But in most other cases, we like to see that there's a history of you renting out properties in the past. And we did run across a client this year that made an error on their taxes. They claimed that they had rented out a property for 365 days of the year. They claimed that they paid taxes and insurance on it. They claimed that they did repairs on it. They even claimed some depreciation on that property. But what they forgot to claim is that they made rent every single month. So it looked like they lost $15,000 on those taxes when in fact they really broke even. And it was something that we kind of talked about and had to work through and really talk with them about how to go about amending that and fixing that. But it was just, again, a simple error that can make a huge difference in your mortgage qualification.
And then the last thing we're going to talk about is what if you find an error and you're still wanting to buy a home, you're still wanting to move forward. Are there circumstances that you can go back and amend your taxes? Now, again, we're not tax advisors, but these are real life scenarios that you've actually been a part of where we can at least guide them to ask the right questions. How does that work?
Sure. I mean, the best advice I can give you is make sure that your taxes are correct before you make a loan application. Because if they're not...
How do you know it's correct?
Right. Well, like I said, have a good relationship with your accountant. Make sure you're reviewing them with them every single year.
Yeah.
But if you've made loan application to try and purchase a home or pre-qualify for a home, and then you go, oh, well, actually, I made more money than what's on those taxes, so let me just say that I made more money now so that I can qualify. That can be an issue for an underwriter because they have to make a judgment call. Well, are you just making this change so that you can qualify for the house that you want, and then you're going to go right back to writing things off? Or was it a legitimate mistake? So, it's one of those things that if we can show that it was just a legitimate mistake and you went and you fixed it, usually we can work through that. But you always got to keep in mind, if you go back and claim more income, sometimes there's a tax implication for that. So always contact your tax advisor. Always reach out to them on any indiscrepancies that you find.
Well, this kind of starts to wrap it up, and one of the reasons why, after 15 years of doing this, I try to tell people, get with a lender quick. If you're 6 months, 1 year, even 2 years out, this gives you time to resolve these issues, fix these issues. So if I understood this correct, you said once you make loan application, that's where the little red flag might come up. But if somebody wanted to come in and say, hey, I believe I want to do this, I'm starting to get myself prepared, would they be able to kind of go through a little bit of the process with you in case you see something that doesn't make sense to give them time to fix it?
Absolutely. I love it when a client comes to me a year out, 2 years out, and says, could I just sit down with you and show you what I've got, talk with you about what my goals are? Because that really allows us to not only maybe identify anything on the taxes or even just understand how their income works, let them know if there is a history that needs to be established. We can also talk to them about any down payments that they might need, any reserve funds that they might need that are going to take time to save up and have. And we can really set somebody on a good plan so that when they are ready, they qualify for the house that they want that's going to meet their and their family's needs.
See, that is such a big piece of this puzzle that I think a lot of people forget is buying a house is one of the largest, most stressful things you will ever do in your life. And people don't take enough time to plan for it so that they can feel at ease. And I encourage you, if you're listening to this and you think you might want to buy a house a year or 2 years down the road, you can consider James part of your tax planning, part of your financial planning, part of your investment planning portfolio. And your tax advisor, your financial planner, they may not know this piece of the puzzle. So it's just one more person to sit down and look at this whole picture to kind of position yourself to have the least amount of stress going through this process. And I love the fact that you're willing to take 6 months to a year, even 2 years out to build that relationship and help them.
Absolutely. We're happy to help and be a resource as far as how different things impact your mortgage qualification all the way through. Our goal is to get you in the right house when the time is right.
All right. Well, I hope this has been helpful. You can reach James at Veterans United. His direct number is
757-340-0013, extension 7182.
And of course, all of this is going to be in the show notes with clickable links and ways to get a hold of him. But thank you.
Thank you.
And I'm glad you're here to really help, not just make money.
Absolutely.
It's the long-term goal.